All right, so let's get right into it. If you've ever, looked up a mutual fund or even a single stock, you have definitely seen those famous Morningstar stars. But what do they actually mean? Today, we're going to crack open that investor's toolkit and really figure out what these powerful ratings are all about so you can actually use them to make smarter decisions.
And, it really all starts with their mission. It's not just about crunching numbers. It's about building tools with one single goal, to empower your success as an investor. It's a pretty powerful idea, right? And it really sets the tone for everything we're about to dive into.
But that really is the million-dollar question, isn't it? I mean, in a world just full of biased advice, how do they actually earn your trust? Before you use any tool, you got to trust the person who made it. So how does Morningstar pull it off in an industry that's, let's be honest, filled with conflicts of interest?
Well, it really starts right here at the foundation. Their entire value proposition, the whole thing, is built on one single word: independence. So let's take a look at how they make that happen. And this really gets to the heart of it. See, Morningstar makes its money from people paying for subscriptions, investors, just like you, not from getting commissions from the fund companies they're rating. That structure is absolutely critical. It's designed to make sure their interests are aligned with your interests.
And you can see that this subscription model, it's not just an idea, it's totally sustainable. Just look at that consistent growth. This means they're not desperate for a quick payday. A financially strong company can actually afford to stay independent and just focus on doing good research without getting pushed around by outside interests.
Okay, so let's grab the first tool from our kit. And this is the one everybody knows, the Morningstar Star Rating. The best way to think about this? It's like looking in your car's rearview mirror. It tells you exactly where a fund has been.
There it is. The classic 5-star rating. I mean, you see this next to a fund you own and it just feels good, right? It looks like a simple stamp of approval, a sure sign that you've picked a winner.
But not so fast. This is honestly one of the biggest misconceptions in investing. Look, 5 stars are great, don't get me wrong, but it does not automatically mean you should rush out and buy it. And understanding why is the absolute key to using this tool the right way.
Okay, so here's the deal. The star rating is 100% about the past. Think of it like a final report card. It's purely quantitative. It looks at a fund's historical performance, adjusts for any sales fees, those are called loads, and, this is super important, it adjusts for risk. Then it grades the fund on a curve against its peers.
So how do they actually make the stars? Well, it boils down to 3 simple steps. 1, they measure the return you actually got in your pocket after fees. 2, they measure the risk you took to get that return. And 3, they rank it against all its peers. The top 10% get 5 stars, the bottom 10% get 1 star, and everybody else is somewhere in the middle. Simple as that.
Now this part is the real secret sauce. Most of the time when people talk about risk, they're just talking about volatility, the ups and the downs. But Morningstar zeroes in on what you and I actually care about: downside risk, the fear of losing money. It specifically penalizes a fund for every month it underperformed a super safe, risk-free investment. So it's defining risk from your point of view, which is pretty smart.
Okay. So if the star rating is our rearview mirror telling us what's behind us, we also need to look through the windshield to see where we're going. And that, my friends, is where the medalist rating comes in.
And the contrast here could not be clearer. Think of it this way. The star rating is the rearview mirror. It's pure math based on what already happened. The medalist rating is the windshield. It's a qualitative human analyst's opinion on what they believe is going to happen. You absolutely need both to get the full picture.
So yeah, this is a forward-looking assessment. It's really about an analyst's conviction. They're basically putting their reputation on the line, looking at all the evidence, and saying, you know what, we think this one has what it takes to outperform its peers down the road.
So how do they come to that conclusion? Well, they dig into what they call the 3 Ps. First, the people running the show. Is the management team any good? Second, the parent company. Do they have a culture that puts investors first? And third, the process. Is their investment strategy solid and repeatable? And then they had a huge one: an assessment of the fees. Because let's face it, lower fees give any fund a massive advantage.
And the rating tiers themselves are super intuitive. You've got gold, silver, and bronze. Gold is their highest conviction pick. Silver and bronze also mean they expect the fund to do well. Then you have neutral and negative, which, are pretty much exactly what they sound like.
All right, let's shift gears completely. We've been talking about funds, which are baskets of stocks. But what if you want to analyze an individual company? Well, Morningstar has a really powerful framework for that too, and it's all built around this one absolutely brilliant concept.
At its core, their stock rating system is based on a really simple idea. Is a stock on sale?
Their analysts do a ton of work to figure out what a company is truly worth, what they call its fair value. Then, they just compare that number to the current stock price. If it's trading at a discount, it looks attractive. If it's way overpriced, they'll tell you that too.
But how do they figure out that fair value? This is where that brilliant idea I mentioned comes into play, the economic moat. Seriously, just picture a medieval castle. What protects it from invaders? A big, wide moat. In the business world, an economic moat is a durable, competitive advantage that protects a company's profits from being eaten away by competitors. It could be a super strong brand, a key patent, anything that keeps rivals at bay. So the analysts assign one of three moat ratings. A wide moat means that company has a seriously strong, sustainable advantage. We're talking something that could last 10, 20 years. A narrow moat is still a good thing, but it might be a little less durable. And none means, well, the company's pretty vulnerable to the competition. And think about it, the wider the moat, the more predictable a company's profits are, which makes it a whole lot easier to figure out what it's really worth.
Whew, okay, so we've covered a ton of ground here. We've got the rearview mirror with the star rating, the windshield with the medalist rating, and this awesome framework for analyzing a company's defenses with the moat rating. So, how do we put it all together into one coherent toolkit? Let's break it down. Here's your game plan. You can use the star rating as your first filter, right? It helps you quickly screen for funds that have a solid track record. Then, for the ones that look interesting, you use the medalist rating to do a deeper dive on its quality and what analysts think about its future. And when you're looking at single stocks, the moat rating is your go-to for understanding if that company has a real, durable competitive edge that can protect it for the long haul.
Look, if you remember just one single thing from all of this, please let it be this. None of these ratings, not one, is a simple buy or sell signal. They are not a magic button. Think of them as incredibly powerful tools that are meant to be the starting point for your research, not the finish line. They're there to help you ask smarter questions and to focus your valuable time on what really matters.
So there you have it. The toolkit is in your hands now. The stars tell you the history, the medals give you a glimpse of the future, and the moat tells you how strong the castle is. The only question left is, what are you going to build first?